The data provided may be incorrect. All information is provided without guarantee. This is not financial advice. Do your own research.
Yeah.
Okay, so with the legal stuff out of the way, let's get into something that feels, well, it's like a Frankenstein's monster of finance, but, in a good way.
A good way. I'm intrigued.
I mean, imagine you take the social feed from Facebook, all the comments, the likes, the sharing, and you just smash it together with the New York Stock Exchange.
Okay.
And then that creation, it moves to Europe, gets really into crypto for a few years, and then decides to grow up and list on the NASDAQ.
That is a terrifyingly accurate description. It really paints a picture.
I'm talking, of course, about eToro Group Ltd. And the timing for this deep dive is, I think, perfect. Because as of today, January 28, 2026, this isn't some fintech startup anymore.
No, not at all.
They are a mature, publicly traded company, ticker is ETIR, on the NASDAQ, with a market cap of around, $2.6 billion. But looking at the research, it feels like a company with a serious split personality.
It really is. It's a fascinating case study. On one hand, you've got this king of Europe, just a cash printing machine. But on the other,
they're basically invisible in the U.S. and are constantly fighting regulators.
Exactly. With a stick.
So that's our mission for this deep dive. We need to get under the hood, figure out how they actually make money, because it is not how Robinhood does it.
Yeah.
We need to dissect this social moat everyone talks about and then navigate the just absolute minefield of regulations.
And ultimately answer the question, right? Is this thing a hidden gem or is it a value trap?
Yes. So to do that, we have to start with the basics. What is eToro?
At its core, it's a multi-asset investment platform. They operate in over 75 countries, something like 40 million registered users. But the key is that multi-asset part. Stocks, commodities, currencies, and, a very big piece of the pie is crypto.
Right, but a lot of apps do that now. So what makes the cash register ring? Because in the U.S., all we hear about is payment for order flow, PFOF. Is that what eToro does?
Generally, no. And this is a super important distinction. In their core markets, the UK and Europe, PFOF is, it's basically banned.
Okay.
So eToro makes its money the old-fashioned way, spreads. Historically, that's something like 87% of their trading revenue.
Okay, let's pause there. Define the spread for someone who isn't staring at a trading screen all day.
Think of it like a currency exchange booth at the airport. You see a buy price and a sell price, and they're never the same.
Right.
If the real market price of a stock is $100, eToro might offer it to you for 110 cents. And if you try to sell it right back, they'll buy it for $99.90. That tiny difference, that's the spread.
So it's basically invisible to the user.
Yeah.
You don't see a commission line item. You just get a slightly worse price.
Exactly. It's baked in. And for crypto, it's even clearer. It's a flat 1% fee built right into the price. It's a volume game. They need people to trade.
So they're not selling your data, they're just taking a little slice. But looking at the recent financials, there's another revenue stream that has just exploded. They're acting less like a broker and more like a bank.
You're spotting the net interest income. This has been a massive, massive tailwind for them thanks to the macro environment. In 2024, it accounted for 20% of their total revenue.
20%. 1/5 of their income is from just holding cash.
Essentially, yeah. They take all the uninvested cash sitting in customer accounts, park it in safe, high-yield bonds or accounts, and they just keep the interest. It's almost free money for them.
Which is fantastic when interest rates are high.
But
yeah. We'll get to the risks of that later, because that free money spigot can get turned off fast.
Precisely. It's a vulnerability. And then they also have eToro Money, their neo-banking arm. They get you on fees there, too. The platform is based in U.S. dollars, so if you're in Europe, depositing euros.
Ah, the classic currency conversion fee.
You got it. Plus, withdrawal fees, inactivity fees, they monetize the movement of money, not just the trading.
Okay, so that's the mechanics. Let's pivot to the thing that supposedly makes them special. The moat. Why do they have 40 million users? What's so social about it?
This is their secret sauce. It's a patented feature called Copy Trader. It lets any user automatically mirror every single trade of another more experienced trader on the platform.
See, I find the psychology of this just fascinating. It's basically saying, I don't know what I'm doing, but that person, Crypto King 99, seems to know, so I'll just hit a button to do whatever he does.
That is the core of it, yeah. And it creates this incredibly powerful economic flywheel. If you're a good trader, you want to be on eToro. Why? Because they pay you. If you become a popular investor, eToro pays you up to 1.5% of the total assets that are copying you.
Wait, 1.5%? That's better than a lot of hedge fund managers get.
It is very competitive. So top talent comes to the platform. That talent attracts the passive users who want to copy them. That generates a ton of trading volume, which generates those spreads we talked about.
And that creates the data advantage. Robinhood couldn't just launch this tomorrow.
No way. They don't have, a decade plus of social trading history. They don't have a leaderboard showing who's been profitable since 2015. That social graph is the moat. It makes the platform incredibly sticky.
It's sticky. If a big trader leaves, they lose their income stream. It's like losing your Instagram following.
Exactly. And that anchors their dominance, especially in Europe. I think something like 70% of their funded accounts are in Europe and the UK.
Which leads right into their strengths.
Right.
So we've got the social network, the global footprint. But I was looking at their balance sheet from late 2025, and wow, this is not a typical tech company.
No, it's what you might call a financial fortress.
Mm.
As of late 2025, they are sitting on roughly $1.2 billion in cash.
Oh.
And crucially,
No debt.
zero debt, which makes them anti-fragile. While other fintechs are scrambling for capital, eToro is sitting on a mountain of cash.
And they're using it. They bought that Australian company, Spaceship.
Yes, and that signals a huge strategic shift. Spaceship is all about pensions. eToro is trying to evolve from a trading app where you, gamble on meme stocks.
To a wealth management platform.
Exactly. They're launching ISAs in the UK, savings products. They want to be where you keep your money for 10 years, not just 10 minutes.
It's smart, but it's not all good news. We have to talk about the elephant in the room, the United States.
The glaring weakness. It's the biggest capital market in the world, and eToro is. Well, they're a nobody here. They were very late to the party.
And the product isn't even the same, is it?
Not even close. In Europe, the secret is CFDs, contracts for difference. It lets you use leverage, short selling. All that stuff is banned for retail in the U.S. The SEC doesn't allow it, so the U.S. product is just a stripped-down version.
Plus, the app itself is.
Well,
it's a lot. I've heard people say it's too complicated.
It's the super app problem. It's a wallet, a broker, a social feed, a bank. For a power user, great. For a beginner who just wants to buy one share of Apple, it can be intimidating.
And it's more expensive. You're paying for those social features through the spreads.
You are. It's a premium product, and in the U.S., where free trading is the expectation, that's a tough sell.
So who is steering this ship? The CEO, Yoni Askia. What's the strategy here?
He's the co-founder, very much a visionary type. But the impressive thing is the pivot the whole management team made after 2022.
The turnaround story. Because they were burning cash before that, right?
Growth at all costs mode. Then the market turned and they just slammed on the brakes. Slashed marketing, focused on profitable growth, and started targeting high-value users, not just every small account.
And the numbers show it worked. Let's get into the financials. 2024 was a monster year.
It truly was. Revenue hit $931 million, up 48% year over year. But the bottom line is the real story. In 2023, their net income was just $15 million.
Okay.
In 2024, a net income of $192 million.
From $15 million to $192 million, that's a massive swing.
It proves the model can actually print money when they're disciplined, and the recent momentum is holding. AUA assets under administration hit $20.5 billion in October 2025.
That's up 73% year over year.
Now, to be fair, some of that is just the market going up, but the
Right.
funded accounts are also growing steadily, around 17%.
And management is so confident they're buying back their own stock.
The ultimate vote of confidence, a $150 million share repurchase program. That tells you they think their own stock is the best investment they can make.
Okay, so we have a profitable, cash-rich company growing fast. Why is the valuation only $2.6 billion? They IPO'd at more than double that. What is the market so afraid of?
3 letters.
SEC.
The regulatory risk. It is the sword of Damocles hanging over this stock. In 2024, they settled with the SEC. The fine was small, only $1.5 million, but the terms were harsh.
They had to gut their crypto offering in the U.S.
Drastically. They had to limit U.S. trading to basically just Bitcoin Cash, and Ether. For a platform known for altcoins, that's a huge blow. It puts a glass ceiling on their U.S. growth.
And it's not just the U.S., right? It feels like regulators everywhere are waking up.
They are fighting on multiple fronts. ASIC in Australia sued them. The FCA in the UK is scrutinizing gamification, the confetti, the leaderboards.
Which is their whole social model, if you take that away.
Right. If you take that away, are they just an expensive, cluttered broker? That's the fear.
And then there's the macro risk. We talked about crypto being, 25% of the revenue?
It's a double-edged sword. A crypto bull run is amazing for them. But another crypto winter, that revenue stream just evaporates.
And the interest rates.
The other big one, That 20% of revenue from interest income is free money right now. If central banks start cutting rates in 2026, that could be a couple $100 million in pure profit that just disappears.
So let's bring it all together with the valuation. Where are we today?
Stock's around $31.47, market cap of about $2.63 billion.
Which just feels low. I mean, they have $1.2 billion in cash.
That's the value argument. Nearly half their market cap is just cash on the balance sheet. So the actual business, the market is only valuing that at about $1.4 billion.
For a business that just made almost $200 million in profit, that's what, a 7x multiple?
It's incredibly cheap for a tech company. But the market is applying this huge discount because of the complexity, the non-US focus, and most of all, the regulatory fear.
It's skepticism. The market is saying, is this profit real, or is it just high interest rates and a Bitcoin rally?
Exactly. It's a show-me story. Show me you can win in the US. Show me you can survive a crypto crash. Until then, the stock stays in the penalty box.
So you have a profitable, cash-rich company that dominates Europe, but it's treated like a distressed asset because it can't crack America.
That's the perfect summary. A unique beast. Defensible moat, prints cash, but it's geographically lopsided and has this regulatory storm cloud overhead.
So what's the takeaway?
You're looking at a company with what seems like a limited downside because of that cash pile. It's hard to go to zero when half of you is cash. But the upside, that depends entirely on execution. Can they navigate the SEC? Can they successfully pivot to wealth management?
It's a show-me story for 2026. They've got to prove they aren't a one-trick pony.
They did the hard part, becoming profitable. Now comes the harder part, becoming sustainable and compliant everywhere.
So here's a final thought to chew on. With $1.2 billion in cash and a depressed valuation, does eToro eventually just buy a U.S. player to get a foothold? Or does a big U.S. bank look at their tech and European dominance and decide to buy them?
M&A is definitely on the table. With that cash and that low valuation, they're either the hunter or they are very, very attractive prey.
Something to watch. Thank you for watching. See you next time.